Hi, and thank you for watching my market report. I am Mike, and a little bit about myself is I am a loan officer with a national lender. So if you got questions about mortgage rates or mortgages in general, programs, refinances or purchase transactions, please feel free to reach out anytime. This report is about mortgage rates, what affects them on a daily basis, and why they change uh, on a daily basis, and so we'll start off today with the economic report. We do got a few items here. We'll start off the Philly Fed Index. This is a index that gauges the manufacturing in the Philadelphia region. So anything above zero is expansion. The previous month in February was a pretty good month at 23.1. Forecast is supposed to kind of remain in that same range at 23. However, it jumped all the way up to 51.8. This is a very hot number. This is a number we haven't seen since 1973. So this just tells you how hot that manufacturing is really heating up, especially in the Philadelphia region. We've been kind of seeing this quite a bit, even in Chicago and New York region, where manufacturing has jumped up as well. So we'll see if it maintains that, but it could be just something because the whole COVID lockdowns, everything else, things got pulled back a little bit. Uh, that maybe you know things got bottlenecked and we're just getting this big spurt. So we'll kind of see what kind of a momentum it carries throughout the year. But this is a great start here. Definitely a pretty impressive number here. Jobless claims. So we get every Thursday. Last week's number came in at 712,000 people applying for unemployment for the first time benefits. However, that did get revised higher to 725,000. Forecast for this week was 700,000. It came in much higher at 770,000. So more people applied for unemployment, unfortunately. As you can see here, some we don't really cover, but continued claims did increase as well, or actually did not increase. It was 4.142 million people, and it dropped down to 4.124 million. So fewer people are applying for continuing claims there. Last but not least, we got the leading indicators index. This kind of gives us a foresight of where the future, where the economy is kind of moving towards. This back in January, it rose 0.5%. Forecast kind of 0.3. It came in a little bit lower at 0.2%. So this will be kind of interesting index to keep an eye on if it's gonna, if the economy is gonna be as robust as many people think. This could give us a little bit more of a clue on that as well. Let's check out the headline news. What's going on over there? Stocks are a little mixed today. Dow is the only one in positive territory. We had the Fed talking yesterday. It didn't satisfy everything. Basically they reiterated what they've been doing, which is they're going to continue with the asset purchases. They're going to continue being very accommodative. Rates, the dot plot came in, but they did see a few more Fed members come in and thinking that in 2023 that we could see beginning of rates where before it was closer to 2024 on there. So there's aspirations that maybe we could see rate hikes in there. Now there are questions about this SLR as I touched on yesterday. This is the ratio where they last April the Fed granted basic immunity for banks to not have a limit in terms of the amount of treasuries and bonds in their holdings compared in the ratio to lending, and they wanted to open up lending for that. And as a result, he said there was a reporter asked about it yesterday, and basically said I will comment on that in a few days. So that will be something down the road, hopefully the next few days here, hopefully this week. Uh, but as of right now, he didn't touch on that. Markets, again, with the spike in the yields, they're not feeling that the Fed has addressed that enough, or at least faced the concerns that they are. The Fed basically said they want to wait till the inflation goes at just above 2% and sustain that level. And then also full employment. They want to make sure that employment is at full employment before they make any changes to their policy. And as we had indicated before, back in the fall, they did reiterate 2.5% insurance rate or inflation. They'll raise that bar up to 2.5 average. So what that means is that they will allow it to go up there, but they have indicated that because the bottleneck in the capacity in the supply chain, it might create a temporary or transitory inflationary data. So that means they think it's going to be very minimal. We may have a spike in inflation, but it might come back down once things settle down a little bit. So that's why they stated that they want to kind of keep it sustained above that for a while before they make any decisions, because they don't want to see a spike and then raise rates and then all of a sudden it drops dramatically. So in any case, let's check out, see how mortgage rates are doing today. And they're not doing so well today. As a result, they didn't like the spike in yields. We'll show that in a bit, but we're down 44 basis points, which translates rates jumped up almost a half a point. So that no point loan yesterday now costs almost a half a point right now as a result of that. So we dropped. We did rally a little bit yesterday. After that, as stocks kind of rallied, more money came back in both markets after the Fed. But however, today it just dropped a little bit further. So speaking of such, as you see here, you jumped up. Right now, it's just under 1.74. It did touch off of 1.75 earlier in the day, but right now we're up about 1.74. So pretty huge spike, almost 10 basis points of a jump for the treasuries, which is creating havoc in the mortgage area. So we're getting, of course, mortgage rates are spiking as a result of that. All right. If you guys you guys got any questions or anything I can look at or discuss, please feel free to reach out. Otherwise, I'll see you in tomorrow's video. Have a great rest of your day. Thanks for watching. Bye bye.